In this video, I am going to discuss about direct labor variance. Direct labor variance is the difference between the actual amount paid for direct labor and the budgeted or standard amount for that same labor. It is used to measure the efficiency of labor usage in a business or organization. Direct labor total variance, which denotes by DLTV, has three components: direct labor efficiency variance, direct labor rate variance, and idle time variance. As now you know, total variance is equal to the summation of the components. So, direct labor total variance is equal to the direct labor efficiency variance plus direct labor rate variance plus idle time variance. Before we move on, let's discuss about the clock hours and productive hours. These two terms are really important under direct labor variance. Clock hours refer to the total amount of time an employee spends at work, including breaks, lunches, and any other non-productive time. It is the total number of hours an employee is paid for, regardless of how much work they actually do during that time. Simply, this means this is the total amount of time an employee spends at work, whereas productive hours is the amount of time an employee spends actually performing work-related tasks, such as working on a project or interacting with customers. It is the time during which the employee is being productive and contributing to the company's output. In simpler terms, clock hours are the total number of hours an employee is physically present at work, while productive hours refer to the time an employee spends actually doing work. You need to have a clear understanding about the clock hours and productive hours in order to calculate the direct labor variance. Now let's discuss about the direct labor total variance, which denotes by DLTV. The direct labor total variance is the difference between standard labor cost and the actual labor cost. This is the equation we can use to calculate the direct labor total variance, which is equal to standard direct labor cost minus the actual direct labor cost. This is how we can calculate the standard direct labor cost, actual units multiplied by the standard labor cost per unit. Important thing to note is that actual direct labor cost is equal to the actual cost paid for clock hours. If the actual labor cost is higher than the standard labor cost, this is called an adverse variance, which indicates that the business has paid more for labor than it had budgeted for. If the actual labor cost is lower than the budgeted or standard labor cost, this is called a favorable variance, which indicates that the business has saved money on labor costs. Now let's do this example. As now you know, we do not consider the budgeted production units. Calculate the direct labor total variance, which is equal to standard direct labor cost minus the actual direct labor cost. What is the standard direct labor cost per unit, which is equal to 2 multiplied by 6, $12 per unit. This is the standard direct labor cost per unit. We have to multiply this value by the actual units value in order to calculate the standard direct labor cost. What is the actual direct labor cost? It is the actual cost paid for the clock hours, which is this value. This is equal to negative $3,200, which means $3,200 adverse. This is because the standard direct labor cost is lower than the actual direct labor cost. Now let's discuss about the direct labor rate variance. This denotes by DLRV. Direct labor rate variance is the difference between the actual cost of labor per hour paid to workers and the budgeted or standard cost per hour for labor. This is the equation we can use to calculate the direct labor rate variance, which is equal to budgeted hourly rate minus the actual hourly rate multiplied by the actual clock hours. This is how we can calculate the actual hourly rate. Actual hourly rate is equal to actual total labor cost for clock hours divided by actual clock hours. If the actual hourly rate paid to workers is higher than the budgeted hourly rate, the variance is adverse, indicating that the business has paid more for labor than it had budgeted for. If the actual hourly rate paid to workers is lower than the budgeted hourly rate, the variance is favorable. If the actual hourly rate paid to workers is lower than the budgeted hourly rate, the variance is favorable, indicating that the business has saved money on labor costs. HR manager is responsible for direct labor rate variance because the salaries and the wages of the employees will be negotiated by the HR department, and the HR manager will be the responsible for the HR department. Now let's do this example. As now you know, we do not consider the budgeted production units. We have to calculate the direct labor rate variance, which is equal to budgeted rate minus actual rate multiplied by actual clock hours. What is the budgeted rate? Budgeted rate is $6 per hour. What is the actual rate? They have not given the actual rate directly. So we have to calculate the actual rate, which is equal to actual cost paid for clock hours divided by the actual clock hours. So this is the amount paid and this is the clock hours. So the actual rate is equal to $6.2 per hour. Actual clock hours is equal to 4000 hours. This is equal to negative $800, which means $800 adverse. This is because the actual rate is higher than the budgeted rate. Now let's discuss about the reasons for direct labor rate variance. For favorable variance, lower actual hourly rate, efficient use of labor, improved labor management. Inverse of these points are true for adverse variance. Higher actual hourly rate, inefficient use of labor, poor labor management. Now let's discuss about the term of idle time. This term is also very important under direct labor variances. Idle time is the period of time when an employee is not working but is still being paid by the employer. This may occur for a variety of reasons, such as machine breakdowns, unexpected work stoppages, power outages, or a lack of work to do. Idle time is generally considered to be unproductive time, as employees are not actively engaged in productive work during this time. As a result, it can lead to decreased productivity, increased costs, and reduced profitability for the company. Simply, this means idle time is an unproductive time in a business. Now that we know what is idle time is, let's discuss about the idle time variance. This denotes by ITV. Idle time variance is the difference between actual clock hours and the actual productive hours multiplied by the standard hourly rate in an organization. Idle time variance can be zero or an adverse variance. Idle time variance can never be favorable. This point is really important. Idle time variance can be zero, which means the actual productive hours and the actual clock hours can be the same. In this case, the idle time variance will be zero. The other instance will be the actual productive hours will be less than the actual clock hours, so that the idle time variance will be an adverse variance. Remember that idle time variance can never be a favorable value. This is because actual productive hours will never be higher than the actual clock hours. This is the equation we can use to calculate the idle time variance, which is equal to actual productive hours minus actual clock hours multiplied by the standard hourly rate. As you can see, this is the only variance we use the actual values to calculate the variance. Both of these values are actual values. This is because the business has to wait until the actual performance are measured. Now let's do this example. As now we know, we do not consider the budgeted production units. Calculate the idle time variance, which is equal to actual productive hours minus actual clock hours multiplied by standard rate. What is the actual productive hours, which is this value 3900 hours? What is the actual clock hours, which is this value 4000? Standard rate per hour is $6 per hour. This is equal to negative $600, which means $600 adverse. This is because actual productive hours are less than the actual clock hours. Now let's discuss about the expected idle time variance. Earlier we discussed about the regular idle time variance. This is where the management accountants do not expect an idle time in the next period. But here the management accountants are expecting an idle time for the next period, which is known as the expected idle time variance. Management accountants or the business are expecting an idle time for the next period. This is the difference between the expected idle time and the actual idle time. Expected idle time variance can be 0, favorable or adverse, which means it can be 0, it can be a positive value, it can be a negative value. If you can remember, if the business is not expecting an idle time, the idle time variance can only be 0 or a negative value. But here the expected idle time variance can be a 0, can be a positive value or a negative value. This is the equation we can use to calculate the expected idle time variance, which is equal to expected idle time minus actual idle time multiplied by the standard rate per hour worked. This point here is very important when it comes to expected idle time variance. Actual idle time can be calculated by using the difference between the actual clock hours and the actual productive hours, because we use this amount to calculate the regular idle time variance. As you can see, actual idle time value is here. Now this is very important. Actual idle time will be 0 or a negative value, which means it can be a 0 or a negative value. If it is an adverse value, ignore the negative value. As now you know, actual idle time can be a 0 or a negative value. If it is a negative value, ignore the negative value and use the positive value here. This is because there is a negative value here already. If you use the negative actual idle time here, this whole section will be a positive value. So you will not get the correct answer. In order to calculate the expected idle time variance, we need to take the difference between the expected idle time and the actual idle time. In order to do that, there should be a negative value here. If you use the negative actual idle time, this negative value will become a positive value. That is the reason. And then we have to calculate the standard rate per hour worked. This is how we can calculate the standard rate per hour worked, which is equal to standard rate per hour divided by the efficiency ratio. How we can calculate this efficiency ratio? This is equal to 100% minus percentage of expected idle time. Now let's do this example. As now you know, we do not consider the budgeted production units. Calculate the expected idle time variance, which is equal to expected idle time minus actual idle time multiplied by standard rate per hour worked. First of all, let's calculate the standard rate per hour worked, which is equal to standard rate divided by the efficiency ratio. The standard rate is $6 per hour. So 6 divided by the efficiency ratio, they have given the expected idle time is 2% of hours paid. So this is the expected idle time, which is 2% of hours paid. So the efficiency ratio is equal to 100% minus 2%. So this is equal to 6 divided by 98%. Remember that we need to convert this percentage value into a decimal. in order to calculate the standard rate per hour worked. So 6 divided by 98 divided by 100. This is how we can convert the percentage value into a decimal value. So this is equal to $6.12 per hour worked. Per hour worked. Now let's calculate the expected idle time. They have given us the expected idle time as a percentage of hours paid. So the expected idle time is equal to 2% of hours paid. So what is the hours paid? They have paid for 4,000 hours. So 4,000. So expected idle time is equal to 80 hours. What is the actual idle time? Actual idle time is equal to actual productive hours minus the actual clock hours. Actual productive hours are 3,900 and actual clock hours are 4,000 hours multiplied by the standard rate per hour worked, which is 6.12. This is equal to negative $122.4, which means 122.4 adverse. Now let's discuss about the direct labor efficiency variance, which denotes by DLEV. Direct labor efficiency variance is the difference between the actual number of hours worked, which means productive hours, by employees and the standard number of hours multiplied by the standard hourly rate. This is the equation we can use to calculate the direct labor efficiency variance, which is equal to actual productive hours minus standard hours multiplied by the standard rate per hour. This is how we can calculate the standard hours, which is equal to actual production units multiplied by the budgeted hours per unit. If direct labor efficiency variance is positive, it indicates a favorable variance, which means that the employees worked more efficiently than expected. If direct labor efficiency variance is negative, it indicates an adverse variance, which means that the employees worked less efficiently than expected. Now let's do this example. We do not consider the budgeted production units. Calculate the direct labor efficiency variance, which is equal to actual productive hours minus standard hours multiplied by standard rate. Actual productive hours is 3,900 hours minus standard hours. Standard hours is equal to actual production units multiplied by the direct labor hours per unit value, which is equal to 1,800 multiplied by 2 multiplied by standard rate, which is $6 per hour. This is equal to positive $1,800. This means this is a favorable value. Now let's discuss about the direct labor efficiency variance when there is an expected idle time. Earlier we discussed about the direct labor efficiency variance when there is no expected idle time. But here we are going to discuss about the direct labor efficiency variance when there is an expected idle time. So without expected idle time, this is the equation we use to calculate the direct labor efficiency variance, which is equal to actual productive hours minus the standard hours multiplied by the standard rate per hour. When it comes to expected idle time, there is only one difference in this equation, which is the standard rate per hour will be changed into standard rate per hour worked. Now we know how to calculate the standard rate per hour worked because under expected idle time variance, we calculated this figure. So when there is an expected idle time, direct labor efficiency variance is equal to actual productive hours minus standard hours multiplied by the standard rate per hour worked. Standard rate per hour worked is equal to standard rate per hour divided by the efficiency ratio. Efficiency ratio is equal to 100% minus the percentage of expected idle time. Now let's do this example. We do not consider the budgeted production units. Calculate the direct labor efficiency variance when there is an expected idle time, which is equal to actual productive hours minus standard hours multiplied by standard rate per hour worked. So what is the actual production hours, which is equal to 3900? What is the standard hours? Standard hours is equal to 1800 multiplied by 2 multiplied by standard rate per hour worked. This is equal to standard rate divided by the efficiency ratio. They have given us the expected idle time is 2%. So 100% minus 2%. We calculated this figure, which is $6.1 per hour worked. So the direct labor efficiency variance when there is an expected idle time is equal to $1,830. This is a positive value, so this is a favorable value. Now let's discuss about the reasons for direct labor efficiency variance. For favorable variances, skilled workforce, high quality inputs, effective training, improved processes. Inverse of these points are true for adverse variances. Unskilled workforce, low quality inputs, inefficient training, inefficient management. Thank you for watching. See you in the next video.